Bleak new analysis out from the Dallas Federal Reserve. Central bank officials warning a 20% drop in the housing market in terms of prices is in the cards. And if that happens, that could put a real dent in real personal consumption expenditure. So is a major housing correction unavoidable at this point? Let's ask Peter Boockvar, Chief Investment Officer with Bleakley Financial Group and a CNBC contributor. We use the term bleak on purpose since you're from Bleakley. Peter, you agree with this, that this is a possibility. Do you see that 15 to 20% number that they sort of threw out there as a scenario, a likely one?
Well, in certain markets, for sure, particularly the hot ones. And just to give perspective, over the last 2 years, home prices are up 40%. If you look at the time frame between 2013 and 2022, home prices went up more than the 1998 through the 2007 housing bubble. So it's an extraordinary rise. And now you have 7% mortgage rates, which are 15-year highs. So it has all the ingredients to see a notable fall in home prices. But again, specifically in the hottest markets like Phoenix or Miami. Now, on the other side, there's a dearth of inventory. 92% of people that have mortgages have a mortgage rate below 5%. Many of them are not going to be anxious to get out of those mortgages and move. So the one thing that can mitigate a sharp decline is that dearth of inventory of existing homes. However, new homes, those inventories are building rapidly.
So Richard Bernstein Advisors tweeted out something very interesting to me, Peter, today, and that was, remember what happened to Texas real estate during the energy bust in the 1980s, right? We saw a real downturn there. So what is happening in Silicon Valley and those sort of formerly hot housing markets? We're seeing the layoffs begin. We're seeing a contraction in these sorts of businesses, these growthy businesses, even in the more established businesses like a Meta. We're seeing job cuts. So what happens in those markets, particularly as mortgage rates are above 7%? I mean, it almost seems like, people may leave their homes. Who are the buyers of a home in an area where the jobs are not few and far between, but they're not really hiring at this point, and your mortgage rate is 7%?
Right. It's going to take, to your point, much lower prices. I mean, in the aggregate, housing all in is about 15 to 18% of the U.S. economy. We saw what we heard from Walmart and Target, one of the areas of weakness were things related to the home. But your point about that particular market being weak, yeah, we're going to see pockets like that. I mean, it was only a couple of years ago where it cost you $1.5 million to get a 500 square foot home in Northern California, and that certainly is going to change. But it's also going to change for that entire economy as well, and making it a more attractive place to bring in new jobs. But yeah, there's adjustments to be had here for sure.
In the Dallas Fed's analysis, Peter, they specifically outlined the scenario of a drop in housing prices of between 15 and 20%. And if we saw that drop, it could shave off between 0.5% to 0.7% in real personal consumption expenditures. And I'm wondering, that doesn't sound like a lot, but can you put that into perspective for us?
Well, the wealth effect with housing is much greater than it is for stocks. Consider 65% of households own a home, the balance rent, whereas in the stock market, the top 10% own north of 85% of stocks. So that 5 to 0.7% of 70% of the economy is, on a dollar basis, a very noteworthy number. And that's just looking at it in isolation. Just imagine the ripple effects. As I mentioned, housing is almost 20% of the U.S. economy, and almost 20% of the U.S. economy is in a recession right now that will continue into next year. All
right, Peter, thank you. It's always good to see you. Peter Boockvar of Bleakley.
Thanks, Melissa. Same here.
So then we had Home Depot yesterday, we had Lowe's today, and they were still good, relative especially to Target. What happens now? If we think that this is the ripple effect that is sort of being unleashed in the economy right now, Guy, I mean, what is the writing on the wall in your view?
Yeah, who's impervious to that, right? I mean, look, Home Depot at 18.5 times is cheap to itself, still trades more expensive than the broader market, but it's relatively, I think it's fair in this environment, and they should win to, listen, either side of the equation, Home Depot's proven they're a great operator, but this is what the Federal Reserve wants. As a matter of fact, you go back a couple meetings ago before Jerome Powell left the stage, he actually threw in, and by the way, millennials, I'm paraphrasing, think twice about buying a home. So what's happening right before our very eyes is everything that they want to happen, and to think there are going to be no knockoff effects or we'll be able to sort of skate through this entire thing unscathed on the back of that, I think is foolish. I think there is pain to come in the housing market, and I think we're seeing it in the form of a Target's earnings.
Yeah, I agree. I think, particularly on the concept of millennials, I mean, the housing is really where most Americans pick up their own wealth. And that's, it's just forced saving. And everyone assumes that prices are going to continue to go up. But when we have reached the levels of unaffordability that are at records, it doesn't make any sense to really think that there's going to be an improvement in housing. What's interesting is in the last housing downturn, the majority of people had variable rate mortgages. And this time, everyone did a great job getting 3% mortgages for 30 years. And they're not going to move. Even, really, the only thing that's going to move is, death, divorce, and excesses of debt. So I think it's going to be slow for it to really change, as opposed to other international markets like the UK, where you have so much more variable rate that's going to kick people out because of unaffordability.